What's up, guys? It's James J, the Texas Mortgage Boss, and I'm back. We are in week 2 of our 4-week first-time homebuyer series, and we are walking home buyers, first-time home buyers, specifically, what they need to know as they embark on home ownership. So today we are going to talk about probably the most important aspect, or one of the most important aspects, if not the most important aspect of getting a home, and that is what closing costs are involved. Let's talk about it. All right, guys. So this is one of the most important things when it comes to owning a home. How much are your closing costs? Now, this is a tricky one because there is no one percentage, one number that I can give you. Okay, that's just not possible. But we're going to get as close as we can to at least understanding some of the fees that are involved when you're purchasing a home. Uh, the other thing about closing costs is some of that can be negotiated with the seller. Now, we are in a very, very seller driven market right now. So asking for closing costs from a seller, probably not the best thing to do right now. Okay. But it depends on the situation. So again, we are in week 2 of our eight video series for first time home buyers. Week 1, we talked about how much down payment do you need. We also discussed what credit score you need as well. So if you haven't watched those videos, go back and watch them because it's important information. This week, we're going to be talking about, well, actually, we've already done one video this week. Earlier, we talked about can you get a gift for closing costs. Today, we're going to talk about what closing costs are actually involved in purchasing a home. Now, again, this is a tricky subject because there are people that like to just give a blanket 6%. Okay, I hear that all the time. Not true. Just not true. You can't just throw a blanket statement out there for closing costs because much like credit scores, there is no situation that is exactly the same. So to say 6% of the sale price, and I hear it all the time, it's not necessarily the case for everybody, okay? Because there are situations where the seller will be paying some closing costs. So when you just say 6%, that's just a blanket number, and it's just not to me, it's just not a very accurate number. But you can kind of figure somewhere between probably 3 to 5%, depending on what you can negotiate with the seller. And again, it's a very different market right now. So you may not be asking the seller for anything in the market that we're in right now because it's such a seller's market and sellers have opportunity after opportunity after opportunity to get a new contract. So if you're in competition to get a home, you've got buyer A, buyer B, buyer C. Buyer A makes an offer, doesn't ask for any closing costs. And I mean none. That means home warranty. That means title policy. That means no concessions, no nothing. Okay. Buyer B asks you to pay title policy. Okay. Buyer C asks for title policy, home warranty, and some concessions. Well, concessions mean that's money out of the seller's pocket. Okay. Title policy means that's money out of the seller's pocket. Home warranty means that's money out of the seller's pocket. The market we're in right now, very difficult for any seller to do a lot of this stuff. Now, if I'm a buyer, depending on the situation, am I going to ask the seller? Possibly, yeah. If I'm in a competitive situation and it's a house that I really want, am I going to ask for anything? Maybe not. So with that being said, we're going to talk about closing costs because you need to be prepared as a buyer right now to pay all closing costs. Okay. Everything's different. Every situation is different. Based on what I'm seeing right now, you just need to be prepared to pay for all the closing costs. So what closing costs are we talking about? Now, today I'm going to actually share my screen with you guys so you can see some of the closing costs that are involved. Okay. Now, let me be very clear. These numbers are changing. They have changed. Okay. So start right off the bat with the appraisal fee. Okay. Most appraisals right now are higher than $400. Okay. For multiple reasons. I know we're anywhere from the company that I'm with, we were anywhere from about $500 to $600 for an appraisal. Okay. Appraisers are bombarded right now. They're busy. And when they get super, super busy, you know what happens? Prices go up. They just do. Supply and demand, just like the market we're in right now. High demand, low supply, prices go up. Appraisals are no different. So appraisal fees are probably going to be anywhere from more like 500 to 600 in this market, possibly more depending on where your home is. Depending on where your home is, because appraisers do charge more if they have to drive further, if it's in the middle of nowhere. Depending on the situation, they may charge more. I've got a situation right now where I've got an appraiser charging double just because of where the house is located. It's out in a rural location. Not many appraisers want to go out there, and so they're charging double for it. So right off the bat, the appraisers are probably they are going to be a little bit higher than what you're seeing here. So I would probably plan for more like $500 to $600 on an appraisal as of right now in this market. Home inspection. Okay, so home inspection is not necessarily part of closing costs. Actually, it's not part of closing costs. Okay, you're going to pay the home inspection before you get to closing. Same with the appraisal fee. Nowadays, we normally have the buyer pay the appraisal fee up front. That does not get added at closing costs. So these first two are really not part of closing costs. These are things that are going to be out of pocket. But the home inspection is something that is optional. Okay. If you're buying a resale home, to me, a home inspection is not optional. It's mandatory. You need to have an inspector go through that house with a fine-tooth comb, because there's stuff that they're going to find that you and maybe your realtor just don't see. Okay, they're going to get on the roof. Nowadays, they've got drones, so maybe they don't get on the roof, but they're going to get into that home and dig in a whole lot more, so you know what you're getting into before you actually commit by signing paperwork and purchasing a home. Okay, so the first two are really not part of closing costs. However, you need to prepare for it because these are expenses that you need to pay. Now, the next thing is going to be application fees. It's going to vary. I can't really give you a number on this, but it's going to vary. Assumption fees really nowadays don't really exist because nobody's really doing assumptions anymore. Attorney fees. Okay, these are also fees that are included in closing costs because the attorneys actually read the documents that you're going to sign and prepare a lot of these documents that you're going to sign at closing. So attorneys don't like to work for free, if you didn't know that. Okay, so there's some fees associated with the attorney preparing the documents. Prepaid interest. Okay, so what happens when you buy a home, you're going to pay prepaid interest from the day you close on the house to the end of that month. Okay, this is part of your closing costs. So if you close on the 10th of the month, and there's 31 days in the month, when you get to closing, you're actually going to pay interest from the 10th of the month to the 31st. That's part of your closing costs. Okay, it's just how mortgages work. When you're selling a home and you sell, when you close on the 10th, again, the buyer's going to end up paying the prepaid interest from the day they own it to the day to the end of that month, and then that's part of that. Kind of gets rolled into the closing costs. So origination fee. So lenders like to call this different things. Okay, origination fee. Some people may call it administration fees. Listen, lender's not doing loans for free. Every now and then it may happen depending on the situation, but lenders are in business to make money. Okay, so this is not an unusual fee. It may be called something different, but origination fee could be 0.5%. It could be a percentage. I know our company, we don't charge a percent. Okay, we just charge a flat fee. We don't charge a percentage based on loan amount. We don't do that. There are some lenders that still do that. So you got to be prepared for that. It could be a 0.5 point, could be 1%. Just depends on the lender. So you want to be aware of the fee that the lender's charging because they're not doing the loan for free. Every now and then that does happen. But if you didn't know, lenders are a for-profit business. Okay, it's not a nonprofit. They want to make money, just like the company you work for also wants to make money. So when people want to negotiate lender fees, like, listen, the company you work for is also for profit. I don't care who you work for. They're making a profit some kind of way to be able to pay your salary. All right. So that's all I'll say about that. Discount points. Okay. So discount points are optional in a lot of cases. Now, again, we're in a very different market right now, but a discount point is essentially just a percentage of the loan amount. So what is a discount point? There are people that want to lower their interest rate. So just say we get an interest rate of 3.25. You say, hey, what would it cost me to get an interest rate of 3% or 2.875? Well, we looked that up. It might cost a point. It might cost a point and a half. It might cost 2 points. That is just a percentage of the loan amount is what that is. So if your loan amount, for easy math here, your actual loan amount is $300,000 and it costs you 1 point to get an interest rate of 3%, it's going to cost you $3,000. Hopefully that makes sense. So a point is nothing more than a percentage. In the mortgage industry, we call it a point. For your knowledge, it's just a percentage. That's all it means. So discount points are optional. Sometimes, depending on the situation with credit, the whole credit profile, sometimes there's some higher points depending on your credit score. And we may not have an interest rate that is what we would call par. All that means is it doesn't cost you anything. Okay. We got a lot of mortgage lingo, but par just means it doesn't cost anything. So depending on the situation, there might be a par rate. There may not be. You just don't know what until we look it up. We don't always know if there's going to be a par rate available or if there's not. The market changes all the time, guys. So just be aware that what a discount point is. It's just a percentage. Sometimes it's optional. Sometimes we don't have an option. Next thing here is mortgage insurance. Okay, so mortgage insurance is typically rolled into the loan. FHA charges an upfront mortgage insurance premium. They also charge a monthly. Okay, nobody that I've ever known pays the upfront mortgage insurance on an FHA loan. VA loan, there's no mortgage insurance at all. USDA, it's usually, again, rolled into the loan, and then the same with conventional. It's typically rolled into the loan. So mortgage insurance you're going to pay unless you put down 20% on a conventional loan. You can avoid mortgage insurance, or you're a veteran. That's the only way to really avoid it. Now, upfront mortgage insurance, which is the one right underneath here, rare situations when we do upfront. Sometimes there's a situation where maybe we need to lower the DTI or debt to income ratio. One of the ways to do that is to pull out the monthly mortgage insurance and then have someone pay it up all in advance. Because if we don't have to add mortgage insurance into the debt to income ratio, well, now your debt to income ratio comes down. So there are situations where maybe it makes sense to pay upfront mortgage insurance. Most of the time it gets rolled into the loan. FHA, VA, and USDA fees. Okay, so VA, unless you're 10% or more disabled, you are going to pay a funding fee. Again, that gets rolled in. USDA also charges a fee for using USDA. Okay, USDA is a no down payment loan, but guess what? They charge a fee. Okay, just like the VA, there's no down payment on the VA, none. But guess what? You're going to pay a fee. FHA, they also have typically just that upfront mortgage insurance, which I just talked about. That is typically what they charge. And again, the upfront mortgage insurance is not your homeowner's insurance. Let me be clear. It's not homeowner's insurance. Okay. Mortgage insurance is there to protect the lender. It is not there to protect you. It's there in the event of a default. That mortgage insurance gives some assurance to the lender. Okay. That's what the mortgage insurance is for. It is not your homeowner's insurance. You need to have a homeowner's insurance. Okay. Which brings me to another part of your closing costs, homeowner's insurance. Okay. It gets paid in upfront. Okay, so whether you're escrowing or not doesn't matter. When you close, your homeowner's insurance gets paid a year in advance. Okay. So you close in May, you're going to pay insurance from May 2020 to, excuse me, May 2021 to May 2022. In May of 2022, you're going to pay it again from May 2022 to May 2023. It's paid in advance. In addition to that, if you're escrowing, we are going to take a portion of your escrow. So let me break this down real clear because this affects insurance. Excuse me, this affects the escrow account quite a bit, depending on what time of the year you're closing as well. This is another big, big something for you really to be aware of. Depending on when you close, does have an effect on your closing costs. So let me explain this. So when you close, like we're about to hit the middle of the year here in a few weeks. Okay, so if you close in June and you have an escrow account, so you close in June. The way mortgages work, if you close in June, you're typically not going to have a monthly payment on the mortgage until August 1st. Okay, where I live, taxes come out in October and they're not due until January 31st of the following year. Okay, so what does all this mean? You close in August, you close in June, your first payment is not till August. Okay, so that means you're going to make a payment August, September, October, and then the tax bill comes out, right? Well, to ensure that we have enough money to pay taxes and insurance when that bill comes out, whether we pay it in November or December, which most lenders probably pay around that time frame, November, December. Again, it's not due till January of the following year. I think most lenders end up paying it in November or December. So in order to make sure we have enough in your escrow account to pay the taxes and the insurance, we will collect a little more upfront. Now, keep this in mind. January 1st to the day you close on the house, it's not your house. So you're going to end up getting a credit from the seller for that portion of the taxes because it's not your house. So you're not going to pay taxes on a home you don't own. So January 1st till, just say you close June 10th. Okay, from that time, it's not your house, so you're going to end up getting a credit. But we also will typically take a little bit more. Maybe we take 3 months of taxes and insurance just to make sure that we don't have to come back to you and say, hey, Mr. Seller, excuse me, Mr. Buyer, we didn't take enough insurance from you. We didn't take enough taxes to pay your insurance is a little different. Usually the issue comes with taxes, like we didn't take enough taxes. Just know if the taxes are short, and it happens a lot on new construction because new construction is a little tricky because we have to estimate taxes on new construction because we don't know the prior year. Typically, if you're buying a new construction in 2021, the house may have been built last year or it may have been built the beginning of this year. The point is the taxes were only based on land, and now there's a house there. So new construction, we run into this more so than a resale home that's been lived in, and we've had a tax appraiser go out there and they've already kind of assessed the property. New construction is a little different. So anyway, the closing costs are a little more, I guess, a little bit more as you get closer to October timeframe. We run into some challenges sometimes with closing costs. We just want to make sure that we take enough upfront that we don't have to come back to you and say, hey, we need more money. Okay. All right, let's keep this moving. Upfront HOA fees. This is going to vary. If you've got an HOA, this is part of closing costs as well. Sometimes the seller will pay some of it. Sometimes the buyer will. Homeowners insurance, we just discussed. Title search fees, lender's title insurance, okay, title policy, and owner's title policy. So normally in a I won't say a buyer's market, but in a more equal market, because right now it's completely unequal. Okay, it is very much a seller's market. It's not even close. In a normal market, most of the time the seller will actually pay title policy. Okay, right now it's just not happening. It's not happening. So depending on your situation, depending on how bad you want the home, how many offers you are competing against, and sometimes you don't really know. You may not even want to ask the seller to pay title policy right now. It's just a different market right now. It's a different ball game, and that is something that sellers right now just don't want to pay. Home warranty is the other thing. Okay, so if the seller doesn't pay the home warranty, you want to get one, you're going to have to pay for it. Home warranty is going to vary again, 400, 500, 600. It can go up from there depending on what you add to it. That is also part of closing costs. So this is a real tricky one because, again, there's no real one answer on when it comes to closing costs. It can vary. There's so many factors involved with it. If the seller's paying title, if they're going to offer any type of concession whatsoever, and sometimes sellers are still doing it. I think it's a whole lot less than it's been in previous years, but sellers are still willing to pay some concessions in certain situations. So keep that in mind. This is one of those real tricky ones. And we try to prepare people as best we can. I don't like the blanket 6% number. I just don't like it. I don't think it's that accurate, but I know people hear it. If you want to get a estimate for closing costs, I'll be glad to put together an estimate for you. If you're looking to purchase a home and you need a mortgage, I'd be happy to help you with that. If you just want a little bit more detail, a little bit more accurate for your specific situation, I'll be glad to help you with that. So send me a DM. You got questions, you can reach me, Instagram, Facebook, I'm there. Also, make sure you go check out texasmortgageboss.com. We'll be back next week. So next week, we are going to be talking about appraisals versus inspections. And we're also going to talk about time frames as far as closing, like how long does it typically take? Because we're having some challenges with appraisals right now for sure. It's taking much longer. So you got to factor that in if you are in the process of buying a home or you're already under contract. Keep in mind, appraisals are taking a little longer right now. So you got to keep that in mind. All right. I will see you guys next week. Take care. Have a good one.